It's crucially important for investors to understand what asset managers are trying to achieve with capital. Their investment philosophies, processes and the likes often tell a story far greater than just performance. So what do you need to know when it comes to hedge funds? Gentlemen, welcome to the program.
Thank you.
Okay, hedge funds, we know during the crisis did not exactly get the best coverage and were seen as one of the reasons that we actually saw such a big collapse in the financial markets in 2008. A very different scenario here in South Africa. But Kobe, where do we stand right now? Are we far more comfortable with the hedge fund industry?
I think firstly, if you look at Regulation 28, that kind of underpins what happens in the pension fund space. They firstly have made room for a lot more investment in hedge funds. So they firstly have recognized this as a separate asset class rather than just calling it another asset class or an alternative asset class. I think that's the first thing. So there's certainly, from a regulatory perspective, there's certainly much more room for institutional funds to start investing in these kind of funds. On a private client basis, we continue to see kind of the high net worths continuously investing in these kind of funds. The problem with hedge funds, and as remember we said in a previous program specifically on hedge funds, and I think it was more around absolute returns, is that hedge funds have become kind of a catch-all phrase. And the catch-all phrase in essence means that there's a whole range of these things or different funds. They all have different types of leverages. They're not equally created, and therefore what they need to try and achieve, and what you need to try and achieve as an investor, is trying to understand who you're doing business with, what are the risks associated with them, and why you are in essence investing in those.
Jean-Pierre, perhaps you could add a little bit more insight into this. Given the fact that regulation is starting to tighten up on a global level, hedge funds have never actually been regulated. We're starting to see a movement towards this here in South Africa. It's largely been a self-regulated industry. And one of the reasons that hedge funds actually came about was to protect against the downside and also embarking on riskier and more exotic forms of investment. What is your sense? What is your prognosis? How risky is it right now?
Hi, Lenny. Thanks, guys, for having me today. I think, hedge funds, as Kubi said, is a bit of a catch-all phrase. But I think hedge funds have, the industry has gone a long way to get ourselves regulated in South Africa. And I think what is important for investors to know is that hedge funds are very well regulated across the world, but especially in South Africa. We've instituted some groundbreaking regulation that we really have put in place between industry and National Treasury and the FSB. In South Africa, the only outstanding piece of regulation is the regulation of the actual hedge fund instrument. So you'll think of, let's say, and that's under CISCA. So a unit trust is regulated in many different ways, but primarily you can sell it to the broad public because it's regulated under CISCA. The hedge funds are regulated under a range of different, under phase and a range of other regulations, but not under CISCA at this stage. So although hedge funds are very well regulated, we can't give hedge funds the same type of coverage that you would give the unit trust industry.
That's quite interesting, Roland. Let's get your sense then. I thought hedge funds weren't very well regulated, formally regulated on a global level, at least before the crisis. Things, as we said, are starting to change rapidly. Do you find that the industry is very well regulated right now?
I do think that the hedge fund industry would like to become more regulated, and by doing that become more formalized and therefore have access to a whole new kind of range of clients that they can market the funds to. And we're certainly seeing that in Europe, where they are the equivalent to CISCA in South Africa is called UCITS in Europe, and they have opened up UCITS to allow hedge funds to be regulated on that basis. What that entails is that a lot of the traditional kind of secrecy or non-transparency in hedge funds has to be opened up. So they are undergoing a lot of reporting changes and sort of risk, the risks inherent in these funds are being scrutinized a lot more now. You're getting also these lock-ins being reviewed, performance-based fees are being reviewed. So the whole industry in Europe is in quite a bit of change, and I guess we have to follow that at some point in South Africa. But I do think hedge funds want to be more open and transparent.
I want to show you guys maybe a graph quickly. I mean, if you look at your screen right now, you'll see a 12-month rolling correlation between, and we're reviewing today the PhD Quant Fund, but you're seeing its correlation relative to the all-share index, and that would be in orange. The 12-month correlation, the rolling again against the Orbi, and then the 12-month correlation against the Symmetry Hedge Fund Index. And you can see how the correlations kind of change over time. But the general picture that you get is that the correlations are actually quite low relative to other asset classes. So I mean, maybe this is a question for JP. JP, if you look at those correlations, and I mean what you've achieved in this fund specifically, is that the point of being in a hedge fund, is low correlation relative to other asset classes?
Yes, Kirby, I think that is one of the primary objectives of the industry as a whole. The big difference between a hedge fund and any other fund is that hedge funds are absolute return funds, but not all absolute return funds are hedge funds. And the big difference between a hedge fund and a regular fund is that the mandate allows you to use leverage and to use short selling techniques, which makes them unique. And we believe that one of the only ways that you can achieve truly uncorrelated returns with the market is by deploying both leverage and short selling to try and capitalize on the relative mismatch in pricing between two different assets. So in other words, if you think that one asset is going to depreciate against another asset, the only way to capitalize on that relative value is to be able to short sell the one and to go along with the other asset. So this is an example of where we can use short selling and leverage to provide returns that are completely uncorrelated to the markets. When the markets are doing well, we'd like to have a slightly positive correlation because we'd all like to do well when the markets are doing well. But we want to make sure that our processes are in place, that we can continue to provide positive returns when the markets are having a tough time. And I think this kind of graph shows you that we can make money in difficult times like 2008, for argument's sake.
Jean-Pierre, perhaps you could also give us an indication of what the South African hedge fund industry actually did during the 2008 crisis, and why now pension funds from increasing the allocation to alternative asset classes from 5 to 15% at a time where most people are becoming more cautious. Here we are in South Africa becoming far more optimistic about this particular asset class, which is deemed as risky. Does that mean that we're just so well self-regulated, at least we were back then, that we didn't actually see significant losses that we performed relative to what we saw globally?
Yes, Leni, I think one of the things we need to acknowledge is that South Africa has amazing financial markets and amazing tools that we can use as hedge fund managers in South Africa to compete head-on with the rest of the world. Now, 2008, a case in point, I think the industry as a whole provided a return of about cash plus 3, during a year that most of the traditional markets wrote off between 20 and 30% of their value. So I think we did prove our skill in a global perspective, and I think we showed what hedge fund investment is all about.
JP, can I maybe jump in here? One of the concerns with the hedge funds in the last few years is that the correlations in normal times between the funds is quite low, and that's good. In other words, you're getting diversification from the managers. But in terms of crisis, and actually the graph that Kirby put up shows that at times of crisis like 2008 and this year as well, the correlations amongst the funds and to the asset classes suddenly jumps quite significantly. And the sort of question that raises is that when you need the diversification, you might not be getting it as much, but obviously in the long run, there is diversification there. What is your comment on that?
Roland, I think it depends on what type of hedge fund you are investing in. There are a wide range of different funds, and we'll probably show a graph a little bit later on to show you the huge amount of negative correlation between, say for argument's sake, the fund we will be looking at later and what the market did in 2008. So as a case in point, this particular fund and quite a few other funds did northward of 30% return during 2008, which is about a 60% performance differential. But not all funds, not all hedge funds are designed to provide you with that strong negative correlation. There are also a large host of different hedge funds that are market neutral or equity long short, and some of those funds do tend to have some positive correlation to the equity markets, usually when there's some sort of convergence event. And I think that the statement that you made is relevant to some extent to some funds that have a different design and a different risk return profile. And this also doesn't apply to a large range of other funds. So for argument's sake, the fixed income funds or the managed futures funds that are by their very design uncorrelated to the equity markets.
Do you see why, I mean, it's so critically important that if you've got a hedge fund manager, that you understand philosophy, process, implementation, what that potentially means from a return perspective. Because if you do that at the end of the day, then you're starting to buy into what this manager is trying to achieve for you at the end of the day. And that is critically important. So if you're part of a board of trustees, ensure that whoever manages a hedge fund portion, you understand what they're doing with your money. And if that kind of makes intuitive sense to you. Because hedge funds generally can give you quite a bumpy ride in the short term. I mean, if you have a look at this, the image that you've got on your screen at the moment, it shows the distribution of returns. Again, and we're looking at the PhD Quant Fund over here. And you see it, if you look at the bottom end of the screen, you see a whole range of return categories. And what we've done is we've used them as distribution baskets for different types of returns. Now look at the outsides of this. You can potentially have returns on a monthly basis of minus 10%, which is a fairly large drawdown, and you can see the number of times that happens. And then by virtue of that, on the other side of the screen, which is 9 to 10% and ahead of 10%, in absolute terms. So in the short term, the returns can actually be very, very volatile. And that is important to note. I mean, JP, is that right? I mean, hedge funds are generally, in the short term, much more volatile than, for instance, equities, but you have got, in certain instances, downside protection.
Yes, I think what, Kirby, this example that we're showing here is an example of one of the more risky type of hedge fund profiles. So what I tried to show you here is almost a worst case scenario for investing in any particular hedge fund. The most important thing when you invest in the fund is to make sure that when a hedge fund has a tough time, when the market isn't suitable for that specific hedge fund strategy, you should be making money on the rest of your portfolio. So hedge funds should always be used within a total portfolio construct, and they should act as a type of a shock absorber so that they can take out some of the troughs, but you need to know that you're probably going to be giving away some of the peaks in the good times.
Okay,
so this example that we have here is quite unique in that it is one of the more risky profiles. And it's also interesting to note that this type of distribution of returns is very similar to that of the equity market. So if you're afraid of this type of distribution return, then you should be afraid of investing in equities.
Okay, that's an interesting point.
The most important thing now is that if you're happy with this risk-return profile, you would only invest in this fund if it adds diversification benefits to your total portfolio. So this specific fund is as volatile as the equity market, but it produces positive returns when the equity market struggles, and that's why it's a good idea potentially to include it in a total portfolio construct.
Roland, we've spoken time and time again, risk return. I mean, you've got to look at the risk, and as Kubi was alluding to, you've got to take very strong positions. You've got to buy into the philosophies and the strategies of a specific hedge fund manager. You're looking at someone going short or neutral or taking a long position on something. How do you decide as to which hedge fund manager to use? Because obviously there are many views that you could take out there, especially in times of uncertainty like this.
When we're talking about risk, we must just be a bit more specific. So one of the things, Kobe mentioned the word protection earlier on, we must understand that hedge funds don't necessarily protect your investment, but what they do is they manage volatility. So by being able to go long and short, what they're doing is they in the long run, they're capping your upside because they're never going to be fully exposed to the market, but they're giving you some kind of not protection, but they're giving you some kind of lower volatility on the downside. So if the market goes down, they don't go down as much. So that is the benefit of, from a risk perspective, of using these funds. One has to not forget that they use leverage. And leverage, if it is not used judiciously, can hurt you, as we've seen in many hedge fund strategies before. When they use leverage, their models are making some assumptions based on correlations and things, and those kind of things don't always hold at all times equally strongly. So those are the two counterparties to the risk. And then if we wanted to pick a good hedge fund manager, what we need to do is we need to identify what type of risks they're taking. So for example, they could be taking resource risks or commodity risk or currency risk or emerging market risk or all those kind of risks if it's a global kind of hedge fund. And you've got to see that this fund is taking these risks to this proportion, and what returns do they generate over and above those risks is the best way to do it.
Jean-Pierre, would you agree with that? Just tell us about what you think risk profiles are of hedge funds right now. Do you think we're starting to take a far more cautious approach and conservative approach? An interesting point that Roland made was leverage. Now that we've got more regulation, I'm sure that you can't just over leverage yourself as you please.
Hi, Eleni. Yes, I think, you know, when we talk about leverage, leverage is a very difficult concept to express risk, and it's quite interesting when you try and equate leverage to risk. And we recently sat with the FSB at the JSE specifically to spend a morning with them and go through what leverage really means. And you know, one of the slides that I think the FSB really enjoyed that casts a lot of light on leverage is comparing the amount of risk that you have on book to going long of, say, Anglos. So what we did is we compared the amount of risk in a long-short trade in equities with a traditional investment of just going long of Anglo shares. So basically we started off by saying probably the most risky type of equity strategy that you can have is to go long of a share in one sector and go short of another share in a different sector. So in other words, there are different fundamental factors that are driving the returns of those two companies. So it could be that the one becomes more expensive and the other one becomes less expensive against your view for completely different reasons. So that would be what we would think as quite a risky trade. Now, I can tell you that if you had to go 1 times long of Anglos, which is a traditional long-only position, that would be the same as going 6 times leveraged on Anglos versus, say, ABSA, which is a cross-sector bet. So you can leverage your cross-sector relative value trade between ABSA and Anglos 6 times before you have the same amount of price risk on your book as just buying Anglos outright. Now, another example may be that you may want to go long of Anglos and short of Billiton. Now, those two shares have quite a high correlation. They're in the same sector and they have a lot of the same value drivers. Now, you can think that the relative value between Anglos and Billiton doesn't move a lot. And if you had to go long of Anglos and short of Billiton, you would have to leverage that trade 32 times before you have the same amount of risk than going long of Anglos 1 times. So there we have an example where 32 times leveraged trade is the same amount, gives the same amount of risk than a 6 times leveraged trade, which is the same amount of risk of just buying Anglos outright.